So the S&P 500 sitting at all-time highs, my portfolio sitting at all-time highs. What's new, really? It's been a amazing story in 2025. Last week, I did a video on 3 potentially bearish signals for the market. And this week, I'm kind of going to flip the script and go over 3 bullish signals that the market is presenting right now. And overall, this is going to give you an idea of what is fueling this market rally and what could potentially continue to fuel this market rally. I'm going to go over what I view is the least bullish to the most bullish. So you're going to want to stick around till the end of the video, because the last one I'm going to speak about is a huge factor as to whether or not we see the S&P 500 go up by another 10 or 20%, or whether we see it correct by another 10 or 20%. It's going to be a jam-packed video. You are not going to want to miss a single segment. And if you want to see what is actually driving my portfolio to new all-time highs every single day, you can grab that report in the description. It details my top 4 holdings, my thesis, all that type of stuff. It's absolutely free. Takes you just a few seconds, but we're going to dive right into this one with point number 1. So the first point, and this one does have a bit of a caveat to it, so you're going to want to stick around to the end of this segment because it's a little more nuanced, I guess I would say, than just the outright numbers tell you, and that is the amount of cash that is sitting on the sideline. I believe we're sitting at $7.3 trillion in the United States sitting in money market funds. And this is an interesting one because it kind of works both ways. Historically, when we look to historical numbers, large amounts of cash sitting on the sidelines has typically not been a good indicator. In fact, if we go back to the financial crisis, we can see that a large amount of cash was being stacked up during that period, and we hit ultimately a large-scale correction. And then we get to the point in 2019 where cash was elevated as well. We hit the COVID market crash. The only difficulty here in comparing this data to now is the fact that the financial crisis was a credit crisis. That was a monumental collapse in the U.S. credit system. And I don't really believe that a lot of people were stacking cash at that time because they felt any sort of doomsday situation was going to happen. And when we look to the COVID-19 pandemic, that was just impossible to predict. People were not hoarding cash at that time, predicting that a global pandemic was going to shut down the economies of some of the biggest countries in the world. So I generally do view this as a bullish signal. But again, there are some intricacies I'll go over in a bit. Now, the under indicator here, which is different than 2019, is the fact that money market funds have yielded a lot more returns over historical levels. I mean, we have 2010 to 2020, a situation where interest rates were very low, equities were going through the roof over that time period. Holding money market funds was a very poor decision as a long-term investment, whereas a few years ago, you could get 5%, potentially even north of 5% returns from a risk-free asset. So the environment, the situation where cash is sitting on the sidelines is much different than it has been in history. And when we get to the point right now where the Federal Reserve is cutting, and I'll tell you why this is such a bullish signal in the next segment, this makes money market funds less attractive from a real returns perspective. Those who are holding money market funds right now, because they were fine with that, 5% return, they're not getting that anymore. And they're likely not going to get that in the very near future, as the Federal Reserve is actually predicting multiple rate cuts, consecutive rate cuts through the next few meetings. So the attractiveness of those money market funds are going to fall. And what might happen is that might cause money to flow out of those funds and into more risk-on assets like equities. Even if a small chunk of this $7.3 trillion does end up flowing out of those money market funds and into equities, it is a bullish tailwind for stock. Now, here's the caveat. institutional firms have already put money to work. We're sitting at cyclical lows when it comes to institutional managers holding cash. They have deployed their money, I wouldn't say a long time ago, but they have deployed their cash already. They're sitting at lows in terms of cash. So I think the main driver on this side of things is going to come from the retail side of things, the retail side of those money market funds that are going to come out of those funds and into equities. Brokerage data is kind of highlighting the fact that retail investors are holding more cash than normal. And I think the element here is a lot of them are worried. When you look to institutional cash, it's not the same in the fact that retail investors have mortgages to pay, they have credit cards to pay, they have children to feed, they have, their jobs on the line, they have, they're worrying about the economy. So there is a lot of uncertainty when it comes to the economy due to, the job loss reports, due to tariffs, and it also comes down to inflation. Retail investors will be more worried about the fact that prices keep going up. And if prices keep going up, they will be worried about their ability to sustain their cost of living. And in this situation, they're not going to flood money into equities when they're worried about paying their bills, whether they're worried about the fact if their prices are going to go up 5-10% over the next year. So this creates a different element. And I do believe if the Federal Reserve can manage inflation at the 2 to 2.5% range that it's at right now, interest rates start to come down, which ultimately should fuel corporate spending, should bring on more jobs. Retail investors will become more comfortable going risk on, and we might see some of this cash on the sidelines flood into equities from the retail side of things. We need the situation to become more stable, and we're starting to see that as the Federal Reserve has taken a more dovish approach, I guess you could say bullish approach to rate declines, to the economy, things like that. So if we see more stability in this regard, you're going to see retail investors, at least there's a high likelihood, they get out of those money market funds that are earning them 4% and will probably earn them, it could potentially be below 3.5% over the next 6 months or so here. It could even be less than that, and into equities. Once retail investors get comfortable buying stocks, they will flow out of those assets and into stocks. This historically has happened. And the fact that institutional investors are positioning themselves in risk-on assets already kind of gives you the indication that they are very bullish on the market's future, which should help retail investors get a bit more bullish as well. So everybody, quick break from the video. If you appreciate the content, just want to ask you to like the video, subscribe to the channel, and comment down below. Let me know what you want to see next. Let me know how bullish you are, how bearish you are, any pieces of data that I might have forgotten about in this video. Even let me know how much you're up year to date. I love to see that type of stuff. But let's get back to the point. Now, the second point here is interest rates easing. We've had the Federal Reserve kind of hold off on this over the last while, especially in relation to Canada. Canada had to drop rates very quickly just because our economy was much weaker, but lower interest rates is generally fuel for equities. This is due to a multitude of reasons. For one, corporate debt gets cheaper, which ultimately increases free cash flow. It allows companies to return more through dividends, more to buy back shares, more to reinvest in company growth. Now, the other element to declining rates, and it's not one I'm going to go into detail a lot, is the fact that stocks are valued on a discounted cash flow basis. This is how we value stocks. And a lot of the core fundamentals to discounted cash flows is the fact that you utilize the risk-free rate to calculate the future value of that company's cash flows. And as the risk-free rate goes down, which is effectively the money you can earn on, let's say, U.S. treasuries, 5-year treasury bill, 10-year treasury bill, things like that. As the Federal Reserve lowers rates, those yields often go down, which lowers the risk-free rate, which increases the future value of a company's cash flows. And in this situation, that typically raises the price of equities. And the simplest way possible to explain it, when the risk-free rate is high, with future money tends to shrink. When risk-free rates are lower, future corporate profits tend to be worth more in today's dollars, which ultimately gives a boost to stocks. Now, the Federal Reserve is primarily cutting rates due to stable inflation, but there is an element here, especially in Canada, that they're cutting it due to a weaker economy. And you would come to the conclusion that large job losses, weak economic growth would ultimately result in lower stock prices. But the fact of the matter is, stocks are a leading indicator of the economy. Stocks generally tend to recover or do well before the economy recovers. And this is because the market is forward-looking. We're often pricing earnings 6, 12, 18 months in advance. So the current situation in the economy economy doesn't necessarily reflect what the market is going to price stocks at. So you have a situation where the Federal Reserve believes inflation is stable and they are cutting rates because that is stable, but also to stimulate the economy. You then get more corporate profit. You then get more consumers who are willing to open up their wallets and spend more because rates are ultimately cheaper. Money is cheaper. And in turn, this can fuel economic growth, which ultimately will fuel corporate earnings and the S&P 500 in general, the index on a broad base. The Federal Reserve will generally find the fine line there where interest rates stay low enough that the economy is stimulated, but inflation stays within control. And if the economy starts to overheat and there is a risk that inflation could peak back up, they'll increase interest rates. The other added tailwind for Federal Reserve lowering interest rates is the fact that it makes fixed income less attractive. And when we think of investments, a lot of people it's a standard idea to just think of the stock market, but the bond market is much bigger than the stock market. So if fixed income becomes less attractive, you could see more of that money flowing into equities over fixed income investments, and lower interest rates have the tendency to do that. Now, this is not a guaranteed indicator of potential positive stock returns in the future. I mean, we had interest rate cuts during the financial crisis that ultimately did not save the market. We had interest rate cuts during the dot-com bubble that ultimately did not save the market, primarily because valuations were very, very high. But I don't really think we're in a situation like that with a lot of these mega cap tech stocks. I mean, you look to a company like Google that is trading at 23x forward earnings. This is not a situation like it was in the dot-com bubble where a lot of unprofitable stocks were trading at absurd valuations, unsustainable. So it's a bit of a different situation right now. Now, could this script be flipped if the Federal Reserve starts to cut rates and inflation creeps back up? During a stronger economy, you're going to get higher inflation due to increased consumer spending. So you could get into a situation where the Federal Reserve is cutting into a higher inflation environment, which might cause them to be forced to raise interest rates quicker than expected. You definitely don't want to be cutting rates into high inflation, but there is a lot of data right now that shows it is stable right now. The main fear here is you're cutting into what is believed to be a stable inflation environment, but we have a lot of issues like tariffs that could ultimately push that back up. So it's going to be a fine line to navigate here. Obviously, the people working at the Federal Reserve are probably a lot smarter than you and I when it comes to predicting this type of stuff, but they have been known to make mistakes in the past. But in the grand scheme of things, it looks to be fine right now. Now, the third indicator, and this is probably one of the more bullish ones in my opinion, is the fact that S&P 500 earnings are absolutely crushing analyst expectations. So at the start of 2025, many economists, analysts believe that the S&P 500 would only grow earnings by around 2.8% in 2025. We're on pace for the S&P 500 to grow earnings at a 10.5% pace in 2025. This is almost quadruple the rate that many analysts expected earnings to grow in 2025, which just shows you how hard it is to predict economic moves. The best economists in the world can't do this very accurately. So especially on the retail side of things, I mean, we are outmatched in this regard, which is why I have often said you need to stay invested at all times, which is exactly what I do. Now, many will say that this is solely due to the tech sector, and don't get me wrong, a lot of it is due to the tech sector, but we're seeing a lot of industrial stocks, the industrial sector in general. We're seeing a lot of consumer discretionary stocks reporting higher than expected earnings, double-digit earnings growth in an economy that is supposedly relatively weak. Obviously, these make a much smaller portion of the index in general, but it's still a positive sign. On average, historically, around 60% of companies will top earnings expectations set out by analysts. Right now, we're sitting at 81%. Now, this situation is a bit difficult to judge whether or not its analysts were fairly bearish due to the potential tariff impacts, or truly if these companies are coming over and above what even bullish analysts are predicting in terms of earnings. But fact of the matter is, it is coming out well ahead of expectations, which is why we have the S&P 500 posting yet another double-digit return on the year. Now, I do think one of the main drivers of increased corporate profits this year has been the fact that these companies have been able to maintain, and in regards to the tech sector, actually increase operating margins. So a lot of analysts, and it would have been completely reasonable to predict this, they figured margins would take a hit because of tariffs. They figured that these companies would not be able to pass costs on to the consumer as easily as they did. But it has been a very easy situation where they've simply been able to pass costs on, which have helped maintain margins, which ultimately have boosted profits well above what anyone had expected. Now, here is the big caveat in regards to this, and is probably one of the most important portions of the video, and that is AI-related capital expenditures. This is going to be the biggest driver of market returns moving forward, in my opinion, and it's not even close. If this money, if the large-scale hundreds of billions of dollars that many companies are laying out into AI-related capital expenditures actually turns out to be profitable, it is hard to imagine the S&P 500 not driving double-digit earnings growth in the future as well, especially when we consider the concentration of the earnings power in the large cap tech companies, which are spending the most amount of money. On the flip side, if this spending turns out to be not as efficient as predicted, you're going to get a lot of cash outlays that are eventually going to hit earnings because they are going to be depreciated. So effectively, they lay out all this cash in the single year that it's spent, which will reduce free cash flow. And then over that time, cash flow will normalize, but that depreciation is added to the income statement and will ultimately eat away at earnings. So you need these AI-related investments to offset that in order for earnings to grow. And if it turns out that that money is ill-spent, you're going to have large depreciation over the years that eats away at earnings and ultimately lowers profits. I cannot stress enough how important it is that the money these companies are spending turns out to be well spent. Ultimately, the market values companies on earnings. It doesn't really value companies on whatever story they have. It values them on future projected earnings. And it is very important that these companies are spending this money wisely. And if they do, I am very bullish on the future of the S&P 500 because a lot of these AI expansions have the potential to be very high margin businesses that continue to fuel growth, but there is risk here. I do want to mention that it is far from guaranteed because we really don't know how profitable artificial intelligence will be. There's almost no doubt that it will drive strong revenue growth for these companies moving forward, but the fact you're laying out hundreds of billions of dollars, you need to realize strong returns from that hundreds of billions of dollars worth of spending, or else it ultimately just hits earnings. Now, where do I lie in this regard? If I were to make a bet, I would bet that this money is well spent. I mean, these big tech companies, they've done this for decades. They've provided exceptional returns. They know what they're doing. They've done it for a very, very long time. And in the event that it is not as profitable as imagined, they still do have the core end of their businesses, which generate tens of billions of dollars in free cash flow every single year. So on an index level, you're going to get these hyperscalers that are spending a lot on AI, but also have the backbone of the business that is fueling this. Whereas in regards to the high valuation, speculative, pure play AI stocks that are really going all in on AI, there's not a lot of them in the S&P 500, so I'm not too worried in that regard. I trust the management teams of a lot of these companies. I trust their future growth. I trust the fact they have a lot of very intelligent people at the helm who are managing this. And this is exactly why I stay 100% invested at all times. I own a lot of exposure to these hyperscalers, to these AI companies. And overall, it's just kind of hard not to be bullish in this regard. So everybody, that's it for the video. 3 bullish signals. You had my 3 bearish signals last week. You can take these 6 signals, kind of come to your own conclusion. The one thing that does concern me on the bearish side of things is the fact that there's a lot of short-term indicators that would kind of lead to a market correction. I mean, we have that margin debt, we have the insider buy-sell ratio, and we have the Goldman Sachs speculative indicator. But none of these really lead me to believe that the market will not still continue to drive strong returns over the long term. I mean, to be completely honest, if that bearish video came true and the markets crashed 20, 30, 40%, I'd be stoked because I'm still very much in an accumulation stage and I would love to grab a lot of these companies at a 30% discount. I'd be buying just as much during that environment as I would right now. So long term, my view has not changed whatsoever. So if you like this video, please comment down below. Let me know. I am very happy to make more videos like this, included with the individual stock analysis I do. And if you want that free report, it's down in the description. My top holdings that are kind of driving my portfolio right now, it's absolutely free. It takes you a couple seconds to get. And as always, I appreciate the likes and the subscribes. Helps me grow the channel, helps me create more content that you want to see.